Good morning. Over the last 10 years, many active investment managers have underperformed their benchmark, triggering a massive shift towards cheap, passive, and index-based strategies. And passive investing has really worked great since the end of the financial crisis, for a number of reasons. Quantitative easing and low interest rates have pushed up the value of all assets, meaning there was no need to be discerning and no need to be active. High correlation and risk-on, risk-off environments, which have characterized the market for the last several years, have also meant that active managers have struggled to add value. Quantitative easing and the rise of FOMO investing, the fear of missing out, have pushed so many people into the market, and they have felt that the easiest way to do this is by simply buying the market in a passive way instead of being discerning. But I believe the environment is changing. And although passive looks great in the rearview mirror, investing is all about what lies ahead. The heightened risk and heightened volatility that we have experienced starting last year is likely to stay. This kind of new environment of heightened risk, heightened uncertainty, heightened volatility requires a new investment process. Simply put, when the environment changes, you must adapt your investment strategy. And I believe an active approach that focuses on company fundamentals is the way to go going forward. At LRT, we are active equity managers, and we're looking to invest in companies with three characteristics. We're looking for a company with a moat, some kind of durable, sustainable competitive advantage, the ability to grow and reinvest, and a management team that knows how to use capital allocation as a tool to increase shareholder value. If you have a moat, but you don't have growth, you end up like shareholders of Kraft Heinz, down 60%. If you don't have a moat, but you just have growth, you end up like people that own GoPro, down 90%. And if you have growth and you have a moat, but you don't have a management team that understands capital allocation, you can end up like shareholders of Microsoft under Steve Ballmer's tenure, where the stock went nowhere for 14 years. Now, I want to focus today on the first part of our investment strategy, the moat, or a competitive advantage, because I believe it's very misunderstood. So I want to tell you about how I think about what a competitive advantage is. A competitive advantage is what allows a company to sustain high rates of return on invested capital for many years, potentially decades to come. And a moat, or a competitive advantage, can be really one of four things. Number one, it can be some intangible assets, brand, patent, license, government approval, something that's hard to obtain. Think medical devices or think airplane parts. Secondly, there can be network effects, and those arise anytime the product or service becomes more and more valuable as the number of users increases. Think social networks, payment networks. Third, there can be switching costs, and those arise anytime it's risky, expensive, or difficult for a company to change suppliers. And this leads to long-term relationships with one particular company. Think core banking software or professional software like the one made by Adobe. And fourth, there can be sustainable cost advantages tied to scale or process. And it's very important that these advantages be sustainable. Think some sort of niche industrial company that operates in a very specialized but small market, or low-cost airlines such as Southwest. Identifying the company's competitive advantage and its moat is the first and most important part of our investment process at LRT. Over the last 10 years, markets have been really pushed up by quantitative easing and low interest rates, and passive investing has done very well. But an environment is changing. An environment of rising interest rates and quantitative tightening that we find ourselves in now requires a different approach. And we believe that companies that have sustainable competitive advantages will be well advantaged and perform better in the current environment because they have more sustainable and more durable business models. At LRT, we are active managers and we're focused on companies with durable competitive advantages. And I believe that investors who choose an active approach will be well rewarded in the months ahead. So with that, thank you for listening, and I look forward to hearing from you.